So it's very hard to get a handle on what the value actually is until its trade actually happens. And they don't happen very often.
So we're talking here in the super
Well,
system or in the ETF?
Well, no, in unlisted infrastructure generally, or unlisted assets generally.
Yeah, wherever you're finding them in whichever vehicle. Yeah.
And, of course, many of the big super funds have big holdings in unlisted infrastructure. Listed infrastructure, or listed assets generally, on the other hand, as you pointed out, Phil, are priced every day. There are thousands, tens of thousands, even millions of transactions that go to incorporate all the known information into that price. They're also, subject to regulation. So, when Sydney Airport was listed, it published its accounts in its annual review. Shareholders could go along to the annual general meeting and question management. You knew that every share being traded was at arm's length, so the price was the price. And so that's why we like listed infrastructure. And of course, being listed, investors will pay more for a listed asset because they're prepared to accept a lower return for transparency. So the advantage of an institutional investor is they can earn a higher return because they're not paying this so-called liquidity premium, which is fine if you are the actual institutional investor where you do know the information. But a retail investor is one step removed from that, and that information is not shared, whereas a retail investor can access that information directly from the company in the case of a listed infrastructure. And that's, I think, the key point here, that one's not inherently better than the other. It depends on the circumstances, but more importantly, access to the information. And as a retail investor, you don't get access to the unlisted information.
So hopefully as a retail investor, you can have a lot of unlisted in your super account, and then presumably or possibly you would like to have more of your listed assets in your own personal investment account.
I mean, that's the truth for most Australians who have their super in large super funds, because by choosing one of the large super funds, you are by definition choosing to invest 40% or more of your money in unlisted assets. Whether that's wise or not is a much bigger question, and I think the asymmetry of information makes that an unwise choice for most people. Australia is at the bottom of world standards in terms of its disclosure by super funds, and I think that's a reason why, unless you're being rewarded for it, is a risk that you shouldn't be taking. And there is no evidence that retail investors are being rewarded for that additional risk, that it's being absorbed into the price that these institutional investors are paying for the asset. So if you go back to the principle that listed assets should trade at a higher price, that an investor in a listed asset should be prepared to pay more for the same set of cash flows as an unlisted investor would, because of that liquidity premium, then how can an unlisted investor pay more for the same asset than the market values it at? That's a mathematical nonsense.